All right, so welcome back to now how to secure yourself financially, especially by looking at the morning star here. And since here we have several models like featured content, stocks and funds, portfolio bonds, ETF, and ESG, the environment, social, and governance. So here right now I'm looking at the featured content after I saw the importance of staying investment in the market and the market in terms of recovery. I'm going to make a quick pause here. Uh, no, I won't. No. Uh, yeah, the pause the pause that I want to do is nothing. Nothing. Okay, so here I'm looking at the staying invested in the market. I look at this, and then in the market on terms and recoveries. Okay, and one of the things that struck me the most it was the by looking at this historical data, right? That the whole idea or the whole purpose of this section is by looking at the historical data, see how the market performs, especially for those who want to have or who needs to invest for a long-term horizon, and also to see how risk decrease over time. So by that, I look at something called the stock market contraction and expansions, and that over the last or in the last 49 years of the past capital, or in the last 49 years of the stock market data, there have been 10 market downturns, uh, shaded here in yellow, uh, and this is a contraction phase of a stock market uh, cycle. And by cycle means a complete round in the stock price fluctuation, and this cycles may vary in length and duration. So a contraction is defined when the stock market peak decline by 10% or more. Uh, this are just technicism, and uh, and again, this contraction phase happen at random times, and they may vary in duration. And then I look at the expansion, which measure is the recovery of an index at the very bottom of the contraction to its subsequent peak or to its previous peak, and the subsequent performance of uh, the subsequent performance until the next peak uh, before another 10% decline, right? So contraction is defined by that. So contraction is defined by a peak when the market stock price value decline from its peak by 10%, and the expansion is the measure of the recovery of an index from the bottom of the contraction to its previous peak and the subsequent performance until the next peak before another 10% decline. In this, in here, I look at several concepts. So, for example, like cycles, okay, uh, recovery and index. And the recovery is a long upswing in stock or in price security following a long decline, or a boom in price security following a long decline. And this term is also used to describe the uh, the boom or the upswing in nations' economy activity. And the other is the index, which is a statistical reference of investments uh, expressed as a percentage of in a period of time. So the whole idea of the index is to measure progress. So yes, right. Uh, the thing to know here is that investors should have long-term investment horizons to allow their investment to grow over time. This is the things to know about this. So investors should have a long-term investment horizons and to allow their investments to grow over time. For example, right now my long-term investment horizons might be is for the asset that I have in my house. Perhaps, who knows, because uh, uh, since that house is very, very precarious in terms of how it is right now. But a long-term investment right now might be is, for example, the crypto, right? So that might be a long-term investment horizon or long-term investment vehicle, right? That allow this investment to grow over time. That might be one of them. The other is look at find a way to invest in the stock market at once, right? And then I look at the market in terms of recovery. And this is something that to me it was amazing. How long has uh, how many times this downturns and recovery has happened, and the length or the severity of this, or the severity of that. Meaning, for the most severe uh, market downturn, because the stock market or the U.S. equity market has passed through several downturns and recoveries. Okay, and equity. This is another concept that equity is the total asset minus liabilities. That's one of the definitions. The equity is the total asset minus liabilities. The net worth of a company is another definition. The net worth of a company, the amount of a company once owned, according how much stock he or she had. In other words, how portion of that pie you own from that company. And the value of a property minus is lien. And when I look about liens, okay, and when I look about lien, which is not that, it's a form of security, especially looking at Investopedia. All right, that's right. The lien, which is a legal right to possess another's property until a debt is repaid or an obligation is met. But there are several types of lien, like bank lien. Usually, when you take a loan from a bank to purchase an asset, so for example, if an individual purchases a vehicle, the seller will be paying using the borrow fund from the bank. In turn, the bank will be granted to a lien on the vehicle. If the borrower does not repay the loan, the bank may execute the lien, seize the vehicle, and sell it to repay the loan legally. Right? So this is the mechanism that they have to guarantee that you're going to fulfill your promise. There, period. Are you gonna do that? Are you gonna take your word? Is your word mean something? So bank lien, judgment lien, mechanic liens, and real estate lien. Real estate lien is a legal right to seize and sell real estate property if a contract is not fulfilled. The issue with or one of the things with this lien is that those liens are not guaranteed in labor, you know, especially as a contractor. You as a contractor, you don't have liens guaranteed. That's what happened. You don't have liens guaranteed, and because of that, since you don't have any lien, or you don't have any guarantee of a lien. For example, if the owner of the company or the company that you're providing your service, for some reason they run out of money, they don't want to pay your obligations, or they don't want to do that. How do you do that? You have to go through some institution, hmm? Perhaps some jury. So to prevent that, it is better to get the money up front most of the time. Or once you scale up your business, okay, then start to use those lean and having or find a place where are friendly to business, right? Business friendly, so that they can provide you legal security and also individual security, so on and so forth, right? But that is a lien, right? This comes from equity. So equity is the total amount of assets minus its liability, the total net worth of uh, the total net worth of a company, the amount that you own, uh, the amount that you own, the amount of stock you own in a company, or the value of the property minus its lien, minus its obligation or the debt you have to them. So, since there have been many U.S. equity in the market downturns over time, the most severe downturn marked the start of the Great Depression, and this is one of the things that uh, struck me the most, that impacted me most, because this when the stock market during the 1929, during the Great Depression, when the stock value lost over 80% of their value, 80.3 83.4% specifically, according to Morningstar. So the recovery period was over 12 years. More recently, 44.7% of their value during the early or the stock loss. More recently, stock loss 44.7% during the early 2000 bear market or the dot-com bubble, and this recovery period lasting 4 years and was the second longest in history. You know what it means? Like 4 years, the recovery period. Stock lost 50.9% during the recent 2007 and 2009 bear market, and this downturn lasts for 16 months. The downturn lasts for 16 months, and the stock market recovered after 37 months. So, in March 2012. So, again, this is not a pattern. Causal, causality doesn't mean or correlation doesn't mean causality. No, I think it's the opposite. Uh, causality doesn't causality does not imply correlation. Exactly. causality causality doesn't imply or doesn't mean correlation. But even though, for example, right now we are on the year 2022, uh, January 2022, January 2023, sorry, January 2023, that's right. And we can feel the recession vastly right now, right? Uh, and that means, well, since, for example, the recent stock loss during the 2007 2009, during the banking and debt crisis, when the stock lost for 50.9% of their value, the downturn last 16 months, and the stock market recovery after 37 months. So 37 months is almost 3 years. Like this, like 37 no, what is it, divide, come on, divide by 12 is 3 years. Question: do you really have 3 years to do nothing, to let the market miraculously uh, recover from it, or let the government actually take care of that, the economy? So you're gonna delegate all of that responsibility to them? Good luck with that. I wish you the best. That's the reason, or that's one of the reasons that I starting to take this action. It's like I cannot wait. I cannot wait. Generally, I cannot wait. Generally, I cannot wait. No, no. Generally, I cannot wait. For sure. For sure. It's like generally, I cannot wait. Generally, I can't wait for it. That's all. Generally, I can't wait for it. So that's why I started to look at this to understand the market contraction and expansions and the downturns and recoveries. So things to know is stocks are prone to sudden loss in value for many different reasons. Loss in value for many different reasons. It's like, okay. Uh, and there are several millennials out there that they're living a bubble, basically. They're living the life like in a bubble, or they have the privilege to live a life in a certain bubble because, well, they have parents that they can maintain their lifestyles, or some platform that they can allow them to maintain that lifestyle, so on and so forth, right? But again, they have a common financial substrate for them. So, all right. Mhm. So, to summarize, uh, so in looking at the downturn, the market downturns and recovery, and to see how the market performed, to get a better picture of that, and they have many uh, U.S. equity market in terms. When we talk about equity, is that, so equity is the total asset minus its liabilities, or the total net worth of a company, the portion of stocks you own from a company, or the total amount of property minus its liens, right? Or these obligations or debt you have on that. Okay, so the U.S. equity market return uh, The most severe, okay, the most severe downturn marked the start of the Great Depression. So the most severe downturn marked the start of the Great Depression. So when the stock value lost 80%, over 80% of their value, specifically 83, 83.4% according to Morningstar. Okay, 83.4% of their value. Uh, yeah, 83.4% of their value, and the recovery period lasts for 12 years. More recently, in stock lost 44.7% during the early 2000 or the dot-com bubble, and the recovery period lasting 4 years. And in 2008, 2009, banking and debt crisis, when the stock lost 50.9%, the recovery period uh, was of 37 months, 3 years of that. So, and again, comparing all of these market downturns and recoveries, and to make better decision of what you're gonna do right now, and generally it's like understand that generally what you're gonna do right now. Well, in my case, looking at this uh, course to improve my financial literacy. So stocks are prone to sudden loss in value for many different reasons. Okay, and with that, I can give conclusion to this, right? So long-term data can also show patterns in the market performance. Interesting here. This is another approach to reparaphrase what you have learned. So long-term data can also show patterns in the market performance. Often these patterns are related to broader economic activity, and analysts can use the data to support prediction about future market trends. And again, causality doesn't mean correlation. Yeah, causality doesn't mean correlation, right? So then I started to look now at asset class and downturn here. I thought this I thought I will never reach here. This course looks at downturns and recovery with respect to the asset classes involved. Interesting. Respect to the asset class involved. So, since we already know what are the most classic asset classes, such as bonds, stocks, large or small stocks, treasury bill. So, bond yield during recessions, stock returns, and monetary policy, correlations of varying asset classes with the market, U.S. market recovery after financial crisis, balanced portfolio, U.S. market recovery after financial crisis, all stock portfolio. A balanced portfolio and all stock portfolio. Okay. But here we're going to look at the downturns and recovery with respect to asset class. Okay. Introduction to asset classes and downturn. Okay. I don't get it. Why they have like a beer on your portfolio? Okay. Okay. They have a beer on your portfolio because it's like bear market. Okay. Bond yields during recession. Stock returns and monetary policy. Mhm. Bond yields during recession. The stock returns and monetary policy. In correlation of every asset class with the market. U.S. market recovery after financial crisis with a balanced portfolio and all stock portfolio. This course look at the downturns and recovery with respect to asset class involved. We will look at stocks, bonds, and other class along with some sample portfolio structures. We will also look at the correlation of different assets with the broader market. But you know what? Right now, at the beginning, once my first time when I look at the importance of staying investment in the market, right here, so the staying investment in the market. When I look at this introduction, all right, I barely know about all of this content. I barely know about all of this content. Now that I know the foundation, uh, I can have a better perspective of what am I going to learn here, you know. But once I know the fundamentals, okay. So this course look at downturns and recovery with respect to asset class involved. Okay. And what you will learn is bond yields during recession. Okay. So look at downturns and recovery with respect of asset classes involved. So what you will learn here is bonds yield, stock returns, and the monetary policy, correlation of various asset class with the market, U.S. market recovery after financial crisis with a balanced portfolio or all stock portfolio. This course look at downturns and recovery with respect to the asset class involved. We will look at stock, bonds, and other classes along with some sample portfolio structure. We will also look at the correlation of different assets with the broader market. So when I look next here, okay, another graph. Bond yields are driven by factors such as supply and demand for loan, something that I'm quite familiar here, okay? And especially similar as the stock market, the bond market is also affected by the state of the economy. And the interest rates on bonds reflect the demand for loanable funds. So bonds yields are driven by factors such as the supply and demand for loans. Here, monetary policy and inflation expectation. Okay, demand for loans, monetary policy, and inflation expectation. So short-term government bonds, 453, 1221, and share regions denoted economic recession. Mhm. Interesting. The Federal Reserve used the federal fund rate and the discount rate as its primary tool. And if you know what is the discount rate, is the percentage at which commercial bank ask for loans to the Fed. Okay, and this is something that comes from Investopedia. Okay, discount rate define how it is used by the Fed and in cash flow analysis. Either the interest rate that the Federal charge bank for short-term loans or the rate used to discount future cash flow in discount cash flow. Discount cash flow, and again, all of these are for short term. All of these are for short term, as it is primary tool to implement monetary policy. The federal fund rate is the rate at which commercial banks lend fund each other overnight. Commercial banks lend from each other overnight, and the discount rate is the rate at which the commercial banks ask for short-term loans to the Fed, right? Okay. Uh, and during the recession, the demand for loans falls, and the Fed lower rates to reduce the cost of borrowing to stimulate consumer spending. During expansion, the Fed may want to keep inflation in check and tighten monetary policy by increasing the interest rate. So they so far we are living in an expansion because as they increase the interest rate, or the one is to keep inflation in check, okay, and tighten monetary policy by increasing interest rate. Short-term interest rates, like Treasury bills, have a close correlation with the federal fund rate, which the Fed target through open market operations. Short-term rates have been volatile, whereas long-term rates, which have a maturity of 20 to 30 years, have been relatively stable and have taken longer to react to change in the economy. How bonds rates affect how bonds rates are affected by inflation. Bonds yield, especially long-term bond yields, are sensitive to inflation expectation because inflation can erode the value of the bond over time. If inflation expectations are high, lenders require higher interest rates to lend funds for more than the short term. Therefore, if the inflation expectations remain high, long-term interest rates may take longer to drop, even during periods when the Fed is cutting rates. In the long run, interest rates will even rise instead of fall. Things to note: there has been a general decline of rates since the recession in 1982. Although the interest rates have generally dropped during recession and rising during expansion, there has been a general decline of rates since the recession in 1982. Prior to that, interest rates were driven up because of the oil price shock of the 1970s. Interest rates were driven up because of the oil price shock of the 1970s, and that is the oil embargo made by the petromonarchy to the United States because they were supporting Israel forces in the Yom Kippur War. Holy crap. Holy cow. Holy crowd. Holy crowd. Holy crowd. Holy crowd. Keep in mind that bond yields and price move in opposite directions. When yields for new bonds fall, existing bonds with higher yields becomes more valuable and can demand a higher price. When yields for new bonds fall, existing bonds with higher yields become more valuable and can demand a higher price. When yields for new bonds fall, and when the mean yield is interest, right? When yields for new bonds okay. When yields for new bonds fall, existing bonds with higher yields become more valuable and can demand a higher price. Conversely, when yields for bonds rise, the price of existing bonds fall in order to compete with increased demand for new bonds. Okay, okay. How bonds rates are affected by inflation. I think this is the know-how, the mechanism, how these bonds rate are affected by inflation. Okay, okay. Let me take a pause here. Um, okay, okay. I'm gonna wrap this video here to slowly integrate all of the things that I have learned so far. Okay. And with that, I'll see you in the next video. Bye bye.